Well, welcome everyone. I'm Gene Trowbridge, and this is the Thursday edition of TLG Talks. And today we're lucky to have Kevin Bupp with us. Kevin is with Sunrise Capital Investors. Say hi to everyone, Kevin.
Hi, everyone. Gene, thank you for having me. Excited to be here.
Well, it's good. I have been interviewed on Kevin's podcast. In fact, how many podcasts are you running now? One or two?
I run two. I've been running two now for probably about 5 years.
Tell us about those.
Sure. The first one, which is going on 8 years now, it's called Real Estate Investing for Cash Flow. It's a interview style, for the most part, show where I interview commercial real estate investors in a wide spectrum of commercial asset classes, everything from multifamily mobile home parks to more niche things such as car washes, senior living, self-storage, parking lots, what have you. And so that's what that show is. And then the other one is the Mobile Home Park Investing Podcast. So one of our niches that we specialize in are mobile home parks. And so the title is very telling as to what we talk about on that particular podcast. Everything and anything mobile home parks.
Well, that's terrific. If someone went to your website, would they find out when those podcasts broadcast?
Yes, they would. And they're weekly, but yes, they would.
They're weekly. Mm-hmm. Do you record them and store them on a YouTube channel?
I do the Real Estate Investing for Cash Flow show, the Mobile Home Park podcast, not at this time.
Not at this time. Okay. Well, I think that's the one I was in, the passive investment, investing for passive cash flow one was the one I was on.
That's correct.
Okay. Running for Brews. That's the website, Running for Brews, as in beer, as in brews.com. Is that it? Tell me about that.
That's it. Yeah, no, that was a little a side venture of mine. Something I'm actually really, really proud of. It started way back in right around 2010, and ultimately I've always been a huge fan of craft beer. I think even probably before I was old enough to actually legally drink it. But in any event, craft beer has always been near and dear to my heart, as has health and fitness. And so back in 2000 and I believe it was 2010 when we founded Running for Brews, I wanted to find a way to basically mix my love for running with my run for beer, but also my love with giving back and charitable causes. And so my wife thought it was absolutely crazy. She told me I was stupid for starting this club called Running for Brews, and I started it at one location at a local brewery. And ultimately weekly we'd meet up for a 5K casual run. We'd drink beer and socialize afterwards. And every few months we would do a charitable endeavor, and ultimately it grew to multiple different organizations through a number of different states. And today we still are the largest nonprofit running club in the United States. And so we've, donated tens of thousands of dollars to different charities, done food drives, what have you. And it all started with my love for craft beer. So I'm not involved so much nowadays in that. However, it's living and breathing on its own. And we've got multiple phenomenal organizers that keep it going weekly.
And you're in Clearwater, Florida. That's where you're based, right?
That's correct. Yes.
That's wonderful. Well, I don't know what you do for running, but I do some running myself when my back isn't hurting me, which it is today. So I'm not running this week. But anyhow, that's a good thing. That's kind of catches you. I didn't do any running at all, and then when I was 60, I showed up in Kauai, where we always go on vacation, and there was a sign that says, run the first annual Kauai Marathon. And they had this really cool shirt have you ever been to Kauai?
I have. Last year, yes. Mm-hmm.
Chickens running, and so they had this cool shirt. It was a yellow shirt with a black chicken on there. And I went over to buy one. And the guy says, we can't buy a shirt unless you run. And I said, well, tell me about this. And he started telling me about the marathon. 26 miles, and you have 7.5 hours to finish it. I said, well, I really want one of those shirts, but I can't do that. And he said, well, how about a half marathon? I said, tell me. He said, well, it's half as long, but you still have 7.5 hours. I said, I don't think I can walk for 7.5 hours, but I want one of those shirts. So sign me up. And so the next day, with no training,
oh my gosh,
I went and ran my first half marathon, and as you can imagine, the course was beautiful. The ocean was beautiful. The trees were beautiful. The mountains. It was actually great. And I've run. I think I'm now one of the 58 uh, runners who've run all 12 of them. And they're always run on the first Sunday in September. Last September, it was a virtual run. And so I got my whole company. We went down to someplace in Temecula, California, and ran around a little lake. And when we got all finished, it was 107 degrees.
Oh my gosh.
It was a killer, but I kept it up. So I'm what do they call that? A legacy runner if you've run every event.
Yeah, that's amazing. No, and I'm not too much of a runner anymore. My wife, when I met her, she was the runner. I was a cyclist, and we both kind of agreed to adopt the other sport as well. And that's kind of where my love for running came from. And I still run here and there, but my I guess my outlet is cycling. So I do a lot of long distance cycling.
Well, it's a lot easier on your knees, that's for sure. I've now done 37 half marathons since I turned 60, and
that's fantastic.
I have some back problems, and just this last week I actually went in and had my knees x-rayed, and then we got to get on and talk about business. But anyhow,
well, me too. Well, I just got an MRI yesterday because I've got back problems as well. But
the x-rays went to the doctor, and my doctor said, you've got the knees of a 40-year-old. And I'm not 40, that's for sure. So he said, we better have an MRI. So I just did that last night. So we'll come
look at that. That was MRI buddies.
Yeah. Kevin, how did you get into the syndication business? What were you doing, and what caused you to become one of these crazy guys that's a syndicator?
It's a great question. And, I'm very, very lucky, you could say, because I graduated high school, went to local community college, and I didn't really know what I wanted to do, Gene, as far as being an adult, and didn't know what path I really wanted to pursue or what I really had a passion for, I guess you could say. I'd always been entrepreneurial as a kid, always had side hustles and did creative things to make money. And ultimately, just I say I got lucky because I started dating a girl back then, and her mother was dating a guy by the name of David. David happened to be a local real estate investor. Long story short, I was 19 at the time, and was really intrigued by David. His lifestyle is very different than me growing up. Again, I grew up in a phenomenal upbringing, great parents, never went without, very middle of the road, blue collar, but again, it's all relative, right? You don't know what you don't know and what you don't have. And so very, very good upbringing, but David lived a very different lifestyle, drove a very different car, had a much more flexible, with his time, during the week, what have you. And ultimately he introduced me to his world a little bit. And I essentially, I guess you could say, I worked for David. I had worked for free for David for a little over a year, in between classes and in between tending bar in the evenings, and just really to learn everything I could about his business, to be around it, and about 14 months later, I bought my first single family property. I was 20 years old, and that was the start of it all. And so really, fast forward to your question of, how did I get into syndications? Well, for a period of many years, I basically played the single family game, built up quite a substantial portfolio by the age of 28, about somewhere between $15-20 million portfolio, depending on who you asked for the valuation. By the time I was 28, and that was comprised of single family homes, smaller multifamily properties, and some miscellaneous commercial properties. And that was leading up to about 2008, and ultimately had a very challenging time going through 08, and all those assets, I'll back up, all the assets we acquired. I never syndicated anything. I did have a lot of very high quality private lenders that I had built relationships with, but more so debt lenders than equity lenders. And so everything I'd ever done was either conventional or just a private debt lender, never in a syndication type of format, securities format. And I took a couple year hiatus, had a couple other business from 2008 to 2011, and ultimately dove back into real estate. And that's when my eyes were really opened up to the world of syndication. And honestly, Gene, one of the, as I forget exactly how I was introduced to what a syndication was. I can't recall that exact conversation that prompted me to, kind of dive in and do some research. But I can tell you that when I started doing research, your name, your information, your resources were really some of the only ones really out there that were truly available to the general public, that you could find on the web. You could, you had articles and things like that. Yeah, I believe your book was published already back then, or maybe years thereafter. But in any event, um, and I didn't do my first syndication back in 2011, but I did. We started buying mobile home parks back in 2012. Okay, and that was a new asset class for us, and we bought them, most of them, for the first couple of years with our own capital, or with other private lender capital that we still had relationships with. And but a couple years into it came a point in time where we loved the asset class. We had already proven the concept. It was doing really, really well. We were incredible at finding deal flow, but we were kind of tapped out. We were tapped out. We couldn't do bigger deals, and we were kind of tapped out of our own money, and so that really forced us to dive into the world of syndication, really actually pull back the covers. And so that was the catalyst, is just literally tapped out, wanting to do bigger deals, wanting to play the bigger game, but not able to do it on my own balance sheet. And just, there was only so much you can do. There's limitations. So that's really what enthralled us into the world of syndication.
You won't be surprised if I tell you that that's an answer I hear all.
I'm sure.
You found a deal that you liked, but you didn't have enough money yourself
Yeah.
to do it, so you had to go out and reach out for partners. That's how I got into it. That's how everyone gets into it. So that's great. So what's your strategy now in the syndication business, and how do you think it's going to change, if it is going to change at all, in the next 2 or 3 years?
Yeah, no, that's a great question. So just to give some additional context there, we at present time, actually for the last, I guess you could say, 4.5 years, every syndication that we've done has been a fund structure, not a deal specific syndication. And so we specialize in the mobile home park space. So we just literally a couple months ago rolled out our third mobile home park fund. And so our strategy for the next 3 years is really to help our partners and our team generate cash flow and generational wealth through what we feel are two incredibly recession resilient asset classes, mobile home parks being the first one, and then the second being surface parking lots and parking structures. And so the next 3 years, we're going to continue buying. Both of those asset classes, or both those niches, are still far from being consolidated. Mobile home parks are getting there fairly quickly because there's a very massive supply demand imbalance. There's not a lot of new not a lot of new inventory coming in the market. Actually, there's more going away or being redeveloped than coming on. And so we've got this massive supply demand imbalance, and there's a lot of private equity coming into that space over the last couple of years. And so it is becoming consolidated, but nowhere near where like a multifamily is, or self-storage, what have you. And then parking lots, very similar. In fact, parking lots are probably the most fragmented asset class that exists today, or that I've ever come across. And so we're going to continue buying here over the next 3 years. And again, just launched our third fund. And so we're just the beginning stages of raising capital. We've already closed in the first 3 deals, got multiple more in the pipeline, and going to keep chugging forward.
Well, I think that's good. That I have noticed in my practice a move away from, by certain of my clients, from multifamily to mobile home parks and storage.
Mm-hmm.
Okay, but quite a few people go to the mobile home park business and like it. But that is the truth. They're not building a lot of mobile home parks today. I think there's some political issues on that in the cities, the governments. So you have a lot of local. I suppose you have a lot of mom and pop operators in that business right now, right?
You do. Again, it's quickly getting consolidated. In fact, I'd say that the turbo boosters of consolidation have really kicked in over the past 3 years. A couple of the larger private equity firms, Blackstone, Carlyle Group, they've kicked in billions upon billions of dollars into this very limited space. And so, there's a lot of large institutional players with cheaper cost of capital. So they've been driving cap rates down, and other groups such as ourselves that we're all vowing for the same deals, right? We're all going after the same deals. And unlike the multifamily space, there's not new supply coming onto the marketplace. And so at some point in time, I'm not going to say it's going to ever be 100% consolidated, but at some point in time, it will become another, asset class similar to multifamily as far as consolidation is concerned. And a lot of these existing mom and pop owners, they're either first or second generation owner of the community. They're in their 70s or 80s. They're aging out of these assets. And so time is of the essence. Getting into the space and actually getting a hold of some of these quality assets before they're all gone or before they're owned by groups such as ours or groups such as Blackstone or Carlyle Group, what have you. And so I think there's probably a 7 to 10 year runway, in all honesty, to get that done. So parking lots is a blue ocean, in my opinion, at this point.
Surface parking lots.
For the most part, potentially garages, but we're more interested in surface parking lots. Just it's much more of a covered land play. Parking garages, I'm not going to say we're opposed to them. However, there's a lot more complexities with infrastructure and what have you that go into parking garages. And so surface parking lots in densely populated central business districts and also highly trafficked tourist locations, where there's limited land available. So.
And that's true. When I started doing my syndication in self-storage, which I was in and built a lot of self-storage, the thought at that time was that it was just a land holding asset. A guy would use cement blocks and build a facility, put a fence around it, not have a living manager. And what we decided to do is we decided to build concrete tilt-up with live-in managers and computerized gates and all that stuff. And I know we ran into 6 or 7 year pattern where we could build the spaces. We generally did 2 in every offering. We had 1 piece of dirt under contract, and we were going to raise enough money to build out that project and raise enough money to get a second piece of dirt somewhere to build the second project. And then after they had 50-60% occupancy, we sold them off to people who were long-term operators. I never wanted to be a storage operator. My investors wanted the net worth buildup of adding value through building. And we went through a period where we would build sites that Public Storage would take a letter of intent on. As soon as I went to them with the dirt and the drawings and told them that I had enough orange paint to make it look just like one of their projects, and we would do that. So that was an asset class that I was in, and it certainly wasn't just a land holding anymore. It's a business,
Yeah.
And way back when, I'm talking in the 80s, fragmented, just like you're talking about the mobile home park business. There are a lot of people that own small storage facilities just themselves. They put it on some empty land that they had, vacant land, and so it was that. Now there's huge operators in the storage the storage facility. Well, that's quite interesting. And the first time you did a fund, I tell all my people not to do a fund unless they have an adequate track record. So I imagine when you went out to do the fund, you already owned some mobile home parks. So you could talk about the fact that, yeah, I've done this before.
That's absolutely correct. In fact, I had a conversation this morning with an individual that is a new syndicator, and he's structuring a fund. And I mean, that's really 2 things that you have to have. Number one is a track record, because really your investors are not investing in a particular asset at that point in time. They're investing in you, the sponsor. And if you don't have a track record, where's their faith? What are they putting their faith into? And then the second thing is deal flow, because once you start bringing capital, depending on how you're structured, if you're pulling it in and your pref starts accruing at, call it day 30, the money gets very expensive very quickly. And if you're not deploying it in an efficient manner, it becomes troublesome, very troublesome very quickly. And so 2 things to be, really conscious of. And yes, we did have a track record. We had already done 7 deals individually, with our own capital, and had been in the space for a couple of years already, proved the concept, risked our own capital first and foremost. And, you know, in the initial fund, the catalyst for that fund, it wasn't even why we did a fund versus a deal specific, at least with mobile home parks. It was kind of interesting how that played out. We were always good with deal flow. We never had a challenge getting, opportunities coming through the door, quality opportunities coming through the door. And I remember thinking back, we had a couple of deals on the board, and two deals on the board that were, money was hard, that we were moving forward with, and we were just going to do a deal specific on those two. And within a week, we literally had three more legitimate deals come on the board, like not just now potential warm leads, what have you, but legitimate deals. And ultimately realized that, number one, the legal costs associated with doing 5 individual deal specific syndications, and these were smaller deals. These were like $1 to $3 million deals, right? And so legal costs associated with it, the logistics of doing 5 individual, we're like, let's see if our investors have an interest in diversifying amongst multiple different markets, multiple different assets. And really it's the same asset class. And so we just put it out there. That seemed to be the more efficient manner. But since we had all those deals at one time to take down, and ultimately we got positive feedback from our investor base. And that was the first fund. I mean, that's literally why we pushed to do that first fund. And quickly realized that with the track record and, those successful deals going to that first fund, we were turning money away. And that really, again, was the catalyst to do the second fund. Like that really said, hey, forget the deal specific. Our business model works really well with the fund structure. But again, we've got the deal flow and we've got the capital source coming in. And so if you don't have both of those figured out, a fund is definitely not the way to go.
No, that's true. I think a fund is, it's an acquisition strategy. If you raise the money ahead of time, you can compete with the other all cash buyers, the 1031 investors that are out there, and you can walk into a bank and buy a troubled asset. Who knows if you have the cash? So it's good. And as you just said, it gives the investor diversification, which is always a selling point. So when I talk to people who are getting in the business, I always say that there's going to be 4 questions that you're going to have to answer before anyone gives you any money. And one of the questions is, and I'm bringing this up here because you've used the term we constantly. One of the questions is, well, Kevin, if I give you the $50,000 you're looking for in this deal, what happens if something happens to you? So when you went out to do your first fund, had you already built a team?
Yes, we did. I mean, it was a small team, but yes, there was another principal actually there was 2 other principals in the group, and then we had a few other additional staff. And so it wasn't just me by myself to where if I got hit by a bus, everything fell apart or unraveled.
When sometimes I get people who come to me and they want me to review a deal that they're thinking about investing in, and I generally won't do that. But I always tell them, look at the management structure, and even if it's an LLC, but if there's just one member, just walk away from that deal. Because I have been the replacement general partner managing member for 7 deals in my career, where people have come to me and their deal and their group has exploded because something happened to the manager. And in only one case was it death. So there are all sorts of reasons that the manager can get in trouble and everyone's money is at risk. So I think you have to deal with that's the number one question.
Absolutely.
The second question is, hey, Kevin, have you done this before? And you're able to say, well, we might not have syndicated, but we own 7 parks ourselves. And you just need to get the first syndication done so you can say, hell yes, once. And then you're on your way. So that's good. So I'm doing a series of online courses, workshops that we bring in 15 people, and we call it Rookie Camp. And that's how we're marketing it. If you haven't done a syndication, and I'm very careful about who we let into Rookie Camp, I don't want anyone that's done a deal. I want all people who haven't done a deal. And then we do it on a couple Tuesday and Thursday morning for 3 hours each. And we bring these rookies in and they don't know anything about it. I mean, the typical question is, I want to put 4 or 5 investors together to buy something, but I don't want it to be a syndication. Well, that's not the right question. I don't want it to be a security. So
Yeah.
we start at that basic level and move forward.
Mhm.
So I'm always thinking about getting good advice from the people I've been interviewing. And so the last question I have for you today is, what advice would you give rookies who are getting ready to do their first syndication?
Yeah, that's it's kind of a loaded question, but I'll do my best to at least give you my opinion on what that advice would be, and it goes back to a few things we've already covered. One is proof of concept, and I know that it might not be possible for everybody. I mean, if you truly have no money to your own name at all, then that's going to be a challenge. But I like to say that it's important to risk your own capital, even if it's small amounts. So, for example, if you want to be a multifamily investor and you want to do big multifamily deals, well, then I think it is incredibly helpful that number one, you risk your own capital, do a deal on your own. Maybe it's a 4-unit property, maybe it's a duplex. It doesn't have to be a big multifamily property, but if you want to be a large value add multifamily syndicator, then maybe you do a 4-unit value add multifamily property using your own capital, sharpen your skills, prove your concept, document it all the way through, and then use that as part of your credibility pitch to investors when you go out to pitch them on your bigger syndication or your next deal that's 50 units or 100 units in size, right? I know that it's not really apples to apples, a 4-unit to a 100-unit, but it proves that number one, you were willing to risk your own money. Like you took the leap of faith. It's different taking a leap of faith with your own money than taking a leap of faith with someone else's money. And it should be the same. You should feel the same exact butterflies in your stomach when you take investors' money than when you have your own money and you're putting it into a deal and you're risking it, not knowing if you're going to get it back. Right. I mean, I think it's a very important exercise to have. And so again, it's kind of my opinion, but I think that it's worth its weight in gold. Now, the other thing I would say is that work really hard and look deep inside and figure out what your unique skill set is, right? We all have that one thing that we just do better than all the rest. One thing that we excel at. And more than likely, whatever that is for these new syndicators, that ultimately could add value to an existing team or to another individual that they ultimately might partner up with or build a company with. And so I'd say work really hard to find that unique, whatever your unique skill set is. And if you want to accelerate your path a little bit, take that unique skill set, identify a sponsor that is already years ahead of you, that's already been there and done that. They've already got multiple deals under their belt, and you know use that unique skill set to add value to their organization and figure out how you can bring value to them and their team, and potentially foster a relationship, foster a partnership, or an opportunity to join their team in one capacity or another. That alone will again lend you credibility as somewhat riding coattails of someone that's already been there, that's years ahead of you. And there's nothing wrong with taking that path either. But those are the couple components of advice I think I would give. And again, not each one is applicable to every individual, but generally speaking, that's what I feel.
Well, that's good because if I were to uh, catalog the answers that I've received on all the interviews I've been doing lately with this question, the number one answer is this is not a do-it-yourself business. Don't try to go it alone. Build a team, get a mentor, and you talk about that. And I think that's very true. And the third question that I think passive investors should ask before they invest, and it goes to what you said is, hey, Kevin, are you going to have any skin in the game? In the old days, skin in the game was always just cash, just cash. Are you putting cash up? Today, I think there's two parts of skin in the game. Are you willing to sign the mortgage? And are you putting up cash? And so you have to have continuity. You have to have some sort of a track record, and you have to be willing to put some of your own money in the deal to move on. And, Kevin, one of the things I've been thinking about is that an investor, a passive investor, needs to take some responsibility themselves for being educated in the asset class in which they're going to invest.
Mm-hmm.
when you're raising money for your mobile home park deals or your parking lot deals, you really aren't going to have the time to educate all the investors about the industry. You can tell them about your deal, but I think they have to come to you with some education about the asset classes. Does that make sense?
Absolutely, absolutely. And I think the beautiful thing nowadays, Gene, is that there's a lot of free information out there. I mean, I'm
Right.
thinking back again when I, got started 20 years ago, what have you. You had to wait up till 3 o'clock in the morning to buy some, goofy, CD set or tape set off the TV, right? The late night infomercial, in
That's
order
right.
to find out how to buy properties, no money down. Nowadays, there's an overwhelming number of podcasts and YouTube videos and other sources of content, bigger pockets, forums, what have you, that have additional resources and the ability to understand the fundamentals of any asset class before considering investing in it. And so that's actually one of the unique default benefits that came about with our mobile home park investing podcast. It wasn't the reason we started that show, but in that show, there was a period of time for a couple of years we went very granular into our operations, and then we went through a period where we would do case studies on deals, and then we would do some interviews with other mobile home park operators. Like, we would go through different phases, and what we found is that the majority of our investors, they didn't necessarily come through that source. That's not how they found out about us. However, we would send them very specific episodes based on, where we felt they would be helped, in their knowledge base of mobile home parks, and found that they would dive deep into a lot of those episodes, more than just what we would send them. And it offered credibility, offered education. It was a very well-rounded approach to teach them the business, from our perspective, and then also help us gain additional trust that we know what we're doing. We know this business. We talk about it day in, day out. This is what we do. This is what we eat, live, and breathe. And so I think, a podcast or a YouTube videos, what have you, if you are a syndicator, that is start cataloging what it is you do and share that with your investors. It doesn't have to be a full-blown podcast. But it could be a video, like a YouTube video, or just even very simple recordings. It doesn't have to be anything overly elaborate, but I think that goes a long way in adding value to prospective investors. And again, they can go many other places and find free resources as well.
I made my whole career, whatever that is, out of education-based marketing.
Mm-hmm.
You educate the people, and you don't even have to say that you're marketing, and you end up marketing. So that's where I come from there. There was one other thing I was going to say about this, and then we'll wrap this up. When you take investors in who aren't accredited, they have to be sophisticated.
Mm-hmm.
And I am certain that the level of sophistication is going to be directly related to the asset class. If we're going to syndicate a 40-unit apartment building, the investor needs a certain knowledge to be able to be sophisticated with investing in an apartment building. But just last year, we did actually a Reg A plus offering on racehorses. Now, what's the level of sophistication an investor needs before they're ready to invest in a blind pool of racehorses? Because the SEC says sophistication means that you've got the training, you or your advisors have the training to understand what the hell the investment is and what the risks are. So educating yourself as a passive investor into the asset class so you are sophisticated with regards to that asset class. And, mobile home parks, multifamily, student housing, senior citizen housing, they all have something in common. People sleep there, but they're all terribly different asset classes, and you need to get yourself educated before you're comfortable in investing. That's my feel.
I
Well,
agree.
we've taken a lot of time of yours. I certainly appreciate it, Kevin. Thanks, old MRI buddy. I really appreciate it, and we will talk to you in the future. thanks for spending your time with me, and your advice will be helpful to the people who are watching our broadcasts.
Well, thanks for having me, Gene. It's been a lot of fun, and thank you for all you do in the education world, to put this free content out there and to help us all become better investors. So,
all right,
very
that's
much
always
appreciated.
good, right? Okay, thank you.